financing. And that's really kind of, to me, just absurd. Like, how do you get into escrow and then for it to blow up because of financing? They didn't get approved for whatever reason. That means a lot of lenders aren't doing their job. We're not all built the same, just like you guys aren't all built the same. You guys are realtors. There's just because someone's at RE/MAX or KW or you name the work or real estate company, it doesn't matter. It's the individual that is going to help them procure a property or sell the property. It's the same thing with the lender. It's up to them. How much information do they have? How much knowledge base do they have? Can they educate their client? Can they convey what they need to your clients? That's really important because a lot of times we're not seeing each other eye to eye, especially now with COVID. So it's over the phone. Can they convey that information to them? Are they set up to be able to talk to your clients? Can they get it back to you? Communication is key, but that's not the only thing. You want to make sure that your clients are getting informed. So with that said, just real brief on me. I've been doing mortgages for a long time. I'll say it. I don't want to date myself, but it's been a long, long time. I've seen a lot of ups and downs. The question that I get a lot is, is this a good time to buy? My answer is absolutely, and you should buy when you can. That should be a patented answer for you guys. You should buy when you can, because if you're trying to time the market, you're never going to get there. It's like catching lightning in a bottle. There's so many factors that go into it. It's not just value, it's interest rate as well, right? But I can tell you, everyone who bought 20 years ago today, they're a lot of life. They got a lot of equity. Just even 5 years ago, they've got great equity position, right? So will it go down? Yeah, at some point in time, because nothing goes like this the entire time. It goes like this, right? But that it's on that line. So even if you bought at the low point or the high point and saw it go down low, the next high is probably going to be better than the last high. And that's what you have to convey to them. So let's talk about financing. The first thing is I like to explain to people what's the difference between pre-qualification and pre-approval. Pre-qualification is just that. It's just qualifying to borrow. It's all verbal information. We haven't seen anything. I haven't seen any W-2 or pay stub or bank statement. It's just they tell me, I make $120,000. I have an 800 FICO score. I've got 20% in the bank, right? Can I qualify? Yeah, sure. Based on that, yes, you qualify for an $800,000 sale price with 20% down. You got it, right? But that means nothing. That's just a verbal. And you really want to steer away from that. And you'll get a lot of letters sometimes that say, hey, I talked to a lender on the internet and they issued me this. If you see that pre-qualification, that's nothing. That just means they talked to someone and they sent them out a pre-qualification letter based on the information they provided, right? Which was nothing. You want to say pre-approval. That means that someone like myself has looked at it. I've gotten the W-2s. I've gotten the pay stubs. I've gotten the bank statements. I ran a credit report. So I've checked all the boxes on it. I can see what they've made. I know what their income is. I see what their debt load is. I saw their credit report. I know what their credit score is. I can actually quote them out something accurate because I have all the parameters. So that's what you want, is you want a pre-approval. Because otherwise you're going to spin your wheels because they haven't been looked at by a legitimate lender yet, or an underwriter for that matter. So that's the difference of the two. Steer away from pre-qualification and say, okay, well, talk to my guy. And what I would instruct, if you guys want to write this down, what I tell people is if your client says, oh, I'm already working with another lender, you're going to hear that all the time. But if their lender is in Missouri or Texas or internet or some company you've never heard of, right? And say, look, I understand that, but let me have you talk to my guy. Within 5 minutes, he's going to assure you of one of two things. Either you're getting a great deal with your current lender or he's going to give you a great deal. Either way, you're going to get a great deal, right? So doesn't it make sense to spend 5 minutes with him so that you can make sure that you're getting a great deal? No one can say no to that. I mean, they can, but if they are, you should be kind of a wolf because you guys want to start working with people on your team. It's really important. Once you start working with lenders that are outside, it's really difficult to get information out of them because for us, we're either transactional or relationship-based. I'm relationship-based. So I'm here, my office is right there. I can't hide, right? So if there's an issue or a question you have, you come to me, I have to tell you, right? I can't get around. That's because I'm relationship-based. I do that anyway with other agents that aren't in this office. Transactional lenders will just blow you off. Why? You're a back burner. I'm never going to do another loan with you. I know that because you're in, I don't know, let's say in San Francisco. I'm licensed in Frisco, but I'm not going to work with that agent. I know it's one time. It's just a transaction, right? So am I going to put my time and effort into that relationship and make sure that you're abreast if I've got a lot of other stuff going on? No. So that's why you want to start putting your team together. Get it. They may have a long-standing relationship. Sometimes you just, okay, I get it. They've already bought 2 or 3 homes. They already have a lender that they trust. Totally get it. But that's how you get around that, is you just pitch the thing 5 minutes to assure them that they're going to get the best deal and it's worth their time, okay? All right, so here's the topics we're going to talk about. Sorry, guys. We're going to talk about the documentation list of what we need, credit report, we'll go into credit briefly, income documentation that we get, and then the asset documentation. All of this stuff is going to be generic no matter what loan program you take, whether it's conventional, FHA, VA, or even the non-QM loans that are out there now. It's the same documentation, at least up front. From there, it could be more questions or more documentation required, just based on the information that we get. But this is going to be what I'm looking for. So let's look at the first thing, which is just the basic documentation. I'm going to send out an email, typically to the borrower, and it kind of tells them exactly what I want. It's going to be last 2 pay stubs. It's always 2. Just remember 2. Last 2 pay stubs, last 2 years W-2s, last 2 years tax returns that are filed, last 2 months bank statements. Now from that, there could be more information after I look at the tax returns or their pay stub or whatever it might be. That will show me more stuff. But this is just generic stuff because I want to see their pay stub. I want to see what their current income is, right? I want to see their W-2s because is it on pace to hit the W-2s from last year? Is there a surplus? Well, why is there a surplus? Now begs the question, do you get bonuses or commission? Do you work a lot of overtime? We're going to give a W-2 borrower who just works for a manufacturing company, he gets a W-2 pay stub, right? We're going to give him his base salary, and then we're going to average for the last 2 years any overtime that they work, any bonuses they get, any commissions they get. Now that's important because sometimes people work some overtime. And so it's important for them to use it because they're trying to push the qualification, right? So you want to have a firm breast of that up front, not take a hearsay, but that's why we push them for a pre-approval, because I'm going to send out a verification of employment. It's a form we send to their employer, and they're going to fill it out. They're going to tell us exactly what their base is, how long they've worked there. They're going to spell out, here's the base they earned in 19, 20, and 21. Here's the overtime that they earned in 19, 20, and 21. Here's any bonus or commission for 19, 20, and 21. So I can see it's very easy to compute at that point. Give them their full base. I'm going to average whatever is overtime, commission, and bonuses, right? So that's why we're looking at pay stubs and W-2s to see if there's any difference. Or did it go down? That's the question, well, what happened? Oh, I was off work for 3 months, had a baby. Totally, perfectly acceptable. Let's get a letter of explanation in the file. That's my job, is to comb those, to find out any issues so I can get a letter of explanation so that the underwriter understands what's going on with the file. The underwriter is just like us, just a human that's in a QB somewhere, looking at numbers and papers all day, right? They don't know anything about anything. So when they see that hole, they're like, wait a minute, what's going on there? Because they're risk mitigating for the file. That's what they do for us. That's what an underwriter does, right? So they're analyzing the risk, making sure that it meets all the guidelines. But if they see issues, those are red flags. That's why it's important for us to look at them up front, cure them. So when the underwriter looks at it, they're like, oh, okay, it's addressed. Maternity, good, got a letter, check, moving on. That's why it's really important for us to look at all this stuff. Tax returns are huge because people may not tell you I have a side business that's lost $20,000 every year. Well, that's an issue, right? Because you're telling the federal government, yeah, I'm W-2'd and I make $120,000, but then I have this side car manufacturing or repair stuff that I do, and I write off everything through it, but it's negative $20,000 every year. You wouldn't know that. And all of a sudden we get the tax transcripts back from the IRS and we see that hit. We have to ask the question. That's the question you asked in escrow because they waited, right? And now that question is coming back to to hit you. And that goes into why loans get declined once you're in escrow, because they're not totally underwritten, or people didn't ask the right questions up front, didn't get the right documentation. But all of it stands for a reason of why we're getting that stuff. And you want to make sure that people are putting their eyes on it so that they looked at it and said, okay, there's another question I need to ask, right? The last thing is bank statements. We're just trying to prove source of down payment and closing cost. We need money seasoned in the bank for at least 60 days. So it's 2 bank cycles. That's why I say at least 60 days, but less than 90 days. But you need 2 months bank statements for that money be in there for it to be seasoned. It's important because we're going to look at bank statements. And if we see a deposit that's greater than 50% of their monthly income, we're going to ask, what is that? And we're going to want to see proof, right? And if they say, well, it's cash because I sold some motorcycle, okay, well, let's see the bill of sale of the motorcycle, right? What they're really trying to do is stop fraud for the seller to give any money to the buyer, right? But it could be that their Uncle Tom gave them money for whatever reason. Great, that's okay. That's gift. We allow gift, but there's a form that has to be signed, so it's brought into the file correctly. And that's what we look at. Now, a lot of times that stuff gets smoothed over because it takes some time to get into escrow. So again, 2 months bank statements. It might have been in this period of time this month, but now we don't find a property until May. Well, now I've got April and March in the file. I don't need February. I throw it out. I don't need to ask that question, right? But those are the things that we're looking for. Also, we're trying to get reserves. Depending on the loan program, you need reserves. Reserves just show money. It's not money that they're actually going to use for the transaction. It's just show money that they have in the bank after the close. So the 3 things we're looking for money-wise: down payment, closing costs, and reserves, right? Normally, Fannie Mae products, Freddie Mac products, FHA, VA don't really require any reserves. It's whatever the DU spits out to us and tells us what they need. But you start getting into jumbo lenders, which is anything over at this point, for us here, 647. Anything over that loan amount is going to be considered high balance or jumbo. Jumbo lenders require more reserves. Some require 9, some require 12, some require 15. But you have to hit that number, because if I'm quoting out a rate to that client based on their scenario, and they have to have 15 months in reserves, well, I have to hit that number. And if I don't, I can't give them that rate, because that investor won't take it, right? Now I'm taking it to a different investor, and there becomes an issue going back to the client. Hey, sorry, but your rate just went up a quarter. No one's going to like that story. So that's why we get bank statements, just to see that they have money. After all this documentation, I can then call it out to you guys and say, hey, look, I've looked at it all. They do in fact qualify for the $1 million property. They do in fact have the 20% down. I ran the credit. Their credit score is 805. It's perfect. Their DTI is at 40%. I now can cover the numbers with the client. What I'm doing with the client, I'm going to show what their top is, but I'm always going to ask them, what is your comfort levels? Because it's not so much what I qualify you for, what your max is, it's where do you want to be as a homeowner, right? So that I can tell them, here's your comfort level, here's your max, you decide where you want to go, right? And now if their max is below where they're trying to look at, you guys should close your doors and say, sorry, I'm not getting you into my car, because we can't look at that $1 million property. You don't qualify, right? I'm not going to waste my time, because your time is valuable. Go on and get another client, right? All right, let's go to, yes.
2 questions really fast. On pay stubs, if someone moves from out of state and they're making not a lateral move, so now they're guaranteed to have more money coming in, how does that work if you're only looking at the last 2 years of pay stubs?
So are they staying with the same company or a different company?
Different company.
Okay, I'll give you both.
Okay.
So if they were going unilateral move, they were moving from Tennessee to LA, same company, they're just taking a new position, fine. Because we have a history of it. Right. There's no issue with that. We're always going to give you your base income, right? And because they work for that company, we'll be able to look at base and overtime as well and give them all that. Because there's no issue. It was just a lateral move. And it could be a move up. Right. Maybe they were just, in the plant. Now all of a sudden you're in the administrative and they just got a 50% pay raise. Fine. We'll give them the new income if we can see it on one pay stub. or an employer letter that says, hey, based on this date, I'm going to have this income, that's perfectly fine. We will want to get a pay stub that reflect that. Yeah, but that's easy. Now, it could be that they're moving from Tennessee to LA. Now, all of a sudden, it becomes an issue for income. If they move and they have a job here, fine. You're gainfully employed as long as you're full-time and permanent, and you have an employment letter saying you're coming to LA on, let's say, February 20th. And it's not yet appointed. It's okay. You're going to come. I can look at it and use your income, but I'm going to have to make sure that you're there and verify that you started. Now, that gets a little trickier because it could be that when you were in Tennessee, you did a lot of overtime and you did get bonuses, right? And now you're doing the same job, but now you're working for company X versus company Y. Now I can't give you that overtime in that commission or bonus because there's no 2-year history at company Y. It's a new company, but I can give you your base, whatever that is. That's why sometimes when people move companies, they lose qualifying income because they don't have a 2-year average with that company for overtime bonuses and commissions, right? So hopefully
I'll talk to you more about it later so that we can have more candid conversation about that. My other question was, with the reserve, say that you approve the loan for a certain amount, the house doesn't appraise, are they able to go into their reserves then to put that into the additional down payment now?
Yes, but they can potentially not get that program. Okay, so going back to it, remember the 3 things we're looking for is down payments, closing costs, and reserves, right? Well, you just sucked out money from the reserves and throw it into the down payment section.
Right.
So you've met the first 2 because you have the down payment and the closing costs, but you don't have the reserves now because you liquidated them. Yeah. So that could potentially say, okay, well, you can't go to investor A, they were the best priced out there, but we can still get you a loan. Now we have to go to investor B and C, but here's their rate, right? But that's a little easier conversation to have with a client because it was on them. It wasn't something that we missed. When you miss something, it's really tough to explain that to a client, or they get upset. When it's, hey, you did this, I'm sorry, but you knew. That's why we have these conversations up front. Here's what I need, and I'll tell them I need 12 months reserves. We're going to talk about reserves up front because I don't want to get blindsided. The last thing that I want is a client to come back to me and say, you didn't tell me, or you said, no, so I've been doing this way too long. I've been slapped around. I've been beat up. I've been in the trenches. I know the questions to ask and not ask because, well, if I don't, I get beat up, and that's not good, right? And you guys will learn that as you guys go. So it's just really, just making sure you ask the questions and you've got documentation for it. There was something else I was going to say. They'll come back to me about that. But let's move on. It'll have me on the senior moment. All right, so credit. Credit is huge. It's because I don't care how much money you make, how well you're qualified. If you don't have credit, you're not going to get a loan. Plain and simple. We now use FICO scores to tell us what the borrower would get on interest rate, or even if they can get a loan. Because if they have a 500 FICO score, you're going to get them a loan. I don't care if you make $1 million a year. If you got bad credit, you're not going to get a loan, right? But there's average credit, and there's fair credit, there's good credit, there's very good credit, there's all of that. So it plays into what kind of interest rate I can get that client. The higher the interest rate, the higher the FICO score, the better the interest rate. The lower the FICO score, the worse the interest rate is, okay? And then to get into loan programs. FHA, VA, we really tell people 620, we can go lower, but it's case by case, but you want a 620 minimum score just to get into a conventional or an FHA loan. 620 should be your cutoff. But you're gonna get whacked in pricing because that's a really low FICO score. And the reason why your interest rate is higher is because there's more risk to the investor or the lender, right? They've got the data, they can see it. Over the course of the last 20 plus years, people in this 620 to 650 FICO score range have a 15% default rate. That's huge. Who wants that? I don't want to get into that pool. And then when you go from 650 to 680, now it goes down to only 10% are going to default. You go from 680 to 700, now you're at 2%. And once you get up to the 740, you're like a 0.5%, or if that. So you want the higher FICO scores, right? So you're going to give them the enticement of having better scores by giving them a better interest rate. So that's the rationale of why you get hits, right? It's not just the interest rate that is going to be effective. It's also potentially the mortgage insurance. If they put less than 20% down on any loan, they have to have private mortgage insurance. You've heard PMI, it's just private mortgage insurance. It has no coverage for the borrower, it's for the lender. The mortgage insurance is not for the borrower, it's for the lender in case they default. Then the lender can go in there and pull some of the monies out and at least recoup some of the potential losses they're going to have for the foreclosure, right? So that's what the mortgage insurance is for. And it works the same thing as interest rates. The higher the FICO score, the better the mortgage insurance. The lower the FICO score, the higher the mortgage insurance, if you can even get mortgage insurance. Now, if you go into jumbo, you're probably looking at someone who needs a 680 to 700 FICO score, and you better have a lot of reserves, and you're still going to get whacked in pricing. Jumbo lenders want the cream. They want 740 or better FICO scores. They want 20% down. They want a DTI less than 43%, all that stuff. So it's really important for us to pull a credit report up front, because the client will always say, well, I don't want you to pull my credit report. Well, I get it. I just want you to know I'm basing it off of what you told me your FICO score was. And I can't help them at that point, right? I can give them a quote, but it's not until you pull the credit report that you see all the other stuff. There's some issues there. There's a judgment. There's a lien, right? There's some lates that, oh, what happened? You thought you had a 750 credit score, but remember that credit card that you disputed? Well, that is an issue for us because we have to get it out of dispute because it's not in your FICO score model when they gave you the score because you disputed it and you took it out. So it's out of the equation. So you don't see it. Yeah, you see it on your consumer credit FICO score scores that come out to you, and you see 740, you think you're good. It excluded that. Now for me, I've got to bring it back in, right? And as soon as I bring it back in, your score just went down to 690. So it can hurt you. That's why it's really important for us to look at a credit report so I can see if there's any issues to address, right? And or maybe there's something that shouldn't be there. Well, let's cure it now before you get into escrow. Because your FICO score is 690, you're okay with the interest rate. But if we do some tweaks, I can give you the 740. Pay down credit cards, fix that collection account that's not yours, whatever erroneous reporting, let's get it cured. So that's another reason why you want to get that credit pulled up front. A lot of times people say, no, I don't want to, I don't want to. I hear that all the time. I just tell them, you want to pull it at least once so that you know where you're at. Because right now it's just some cyber number out there. You think it's a 740, it says a 740 because you pull a soft pull, but you really don't know. Our mortgage FICO scores are actually adequate. They're old. The new models that are out there for consumer.com or you get them from banks, all that stuff, free reporting.com, all that stuff, they need free credit reports. They're good, but the score isn't our score. Our score is, we use old models. It's what Fannie and Freddie make us do. So we have to adhere to their government requirements. It's an old model. So we have different scores. I think the consumer models are good because it tells you what's on your credit report. And if there's anything bad, you know what's there so you can fix it. But I want to pull mine so that I can see it because I get it all up. I don't want you to pull my credit report. I'm talking to 2, 3 other people. And if everyone pulls my credit report, I get it. You at least want to pull it once, take it out of cyber. You know what the score is. You have someone who can legitimately tell you what you need to do to fix it if you need to do anything at all. After that, you don't need to pull. There are times like going back to, talk to my guy within 5 minutes. If he tells me, oh yeah, it was pulled, the other company told me it was 765. Okay, fine, moving on. I'll check 765. Why? Because, well, it was already pulled. I don't need to see it, right? So I'm not looking to pull your credit. If you haven't had it pulled, I'm looking to pull your credit. If you already had it pulled, all right, fine.
Do you need documentation of that though, instead of just their word?
Well, it's hard to get documentation because we can't really give you a credit report. When I pull it, I can't give it to the client. There'll be something in the mail that goes to them so they can see what the scores are, but they won't get a hard copy of the credit. Not until we're in escrow, then they pay for it, then I can give them a copy of the credit report. At least that's the legal thing. So if you've got me on recorded, that's what I'm supposed to say. And going into the rapid rescores, that's where we try to fix people's credit. Maybe it's not erroneous credit, maybe they just have a lot of credit debt. And we call it proportional balance to credit limit. It's huge. So just imagine someone who has a $10,000 credit card, and they have $9,000 of credit line used on that. So they're maxed out pretty much. They're $9,000 and a $10,000 limit. That's what the credit model will pick up as a heavy credit user. And they're like, whoa, they're going to get a lower FICO score because they have a high proportion of balance to limit. It's about a third of the score. It's pretty big. So we can have buyer B, who still has $9,000 in credit cards, but he has it spread over 4 cards with a $10,000 limit. He has, we'll say, $2,500 on all 4. He's at 25% of every credit. He's deemed a low credit user, but he still has the same $9,000 in credit debt, right? They both have $9,000 in credit. So it goes to people's mentality of usually they want to use 1 or 2 cards. And I get it. It's a little easier for you to cash flow on a monthly basis. You don't have to remember as many credit cards to pay, all that stuff. I get it. But you're actually doing yourself a disservice. Spread it over those credit limits. Another thing I see a lot is people get stuff in from their credit card companies that says, hey, you've been pre-qualified because you've been a great customer of ours to increase your limit from $500 to $3,000. No, I don't want to do it because I'll get more credit debt, right? So they don't do it. Well, they actually are hurting themselves because they carry a $400 balance on a $5,000 limit, or $500 limit. That's 80%. You're a high credit user. If you jump that to 3,000, you're now just a little bit over 10%. You're a low credit user. So you want to get those bumps, right? So there's a little tweaks that we can help with clients, but I can only do that if I pull a credit report. That's it, right? And I think your boss is coming in here. Oh, take it up on you guys. Yeah.
Quick question about the PMI. Is it true that if the down payment's over 20%, that gets removed?
Correct. It's only required if you're putting less than 20%. Right. And you'll see false advertisement out there that says 10% down, no PMI. That's kind of a misnomer because there is PMI. It's built into the rate. It's a lender paid mortgage insurance because the government requires us to have the mortgage insurance. So we're going to have to put it on the file. You just are paid for it with a higher rate. That's all. I don't like those programs because if you do that, it's built into your rate. Your rate is a contract. It never changes, typically on a 30-year fix. It's not going to change, right? But so you're stuck with that higher rate. Because if you get PMI, at some point in time, you can petition to get it removed, right? And so if you do, you had a lower rate, you had a PMI on top of that, but after 2 years, you can get it removed, and now you just have an interest rate. That's why it's better to go with mortgage insurance and just get it removed after a couple of years, because the threshold typically is 78% loan to value. So you have an equity position at 22. You have to get an appraisal on the property, but it's something you can do. And then it's gone, right? And then you're enjoying the lower interest rate. So, all right. So I think we beat up credit unless anyone has any other questions.
So without petitioning to remove it, the PMI carries through the existence of the loan?
Absolutely.
Okay.
Remember I told you the PMI is for the protection of the lender? Why are they going to automatically just remove it?
Sure.
It's their protection. So even if you're at 60%, you can loan to value, you can still go into default.
Sure.
So they want that PMI there all the time. And they're going to require the person to call them and then actually fill out a form. We'll have to get an appraisal, all that good stuff. But if you meet all the requirements, you'll get it removed. All right, let's go on to then income.
What's the rate right now for conventional?
4.25. Good times. Actually, it's not a bad rate though. I say that, Jesse. It's actually a great rate. We're still below the rates currently at 4.25 are below where we were pre-pandemic. So take that into that thing. Just 2.5 years ago, rates were 4.5 and above. So you're still getting a great rate. It's just people got used to them being so low. So and it's not bad, but we're going to see them continue to go up. We'll probably see them get into the high 4s. Yeah, the feds are going to start increasing rates next month, but that's to short-term rates. That's going to be HELOCs, car loans, credit cards. That'll be affected by that. I won't go too far into it, but they're just doing that to curb inflation, but also to give them an extra lever once the recession hits, which I'll tell you now, recession is going to be here in 2024. We will see rates tumble down below 3% again. But what they're going to do is increase the Fed's fund rate to kind of compensate inflation, to lower it and get it back in line, because right now it's at 7%, which is insane. 2% is a target. They'll bring you back down, but then once the smoke clears and we get out past this, there's a recession movement. And when that recession hits, the only thing the Feds can do, well, there's other things, but one of them is to lower interest rates, and they'll lower it. So they're thinking they're probably going to do anywhere from 4 to 7 hikes this year. They're talking about 3 in the next, or I should say, by July of this year, which given 3 months to be able to do it, 1% increase. So we're thinking at least one of the times they're going to be a 0.5% increase. Could be the first one. But as they go up, we'll see kind of rates kind of trickle behind them a little bit. Not a lot, but a little bit. So we do anticipate them going back into force. But I'm telling clients now, that's okay. I'm going to stay in contact with you because we're going to refinance out there. Right? Just get into the property, make sure you like it, it's good bones, where you want to set your roots, community, all that stuff. Because when that recession hits, the rates go back down, you're going to refinance.
Yeah.
Right? And then you're going to be enjoying the low rate. After that, who knows? But I every morning, that's the first thing I do is I go onto the gurus that tell me about the bonds. It's crazy stuff, but this guy has been right for so long. It's just really just educating us of what the bond market is doing. And that's where interest rates are. So he's just advising us like potential effects of the bond market. Should we lock or not? Really, that's what we're looking for. So we can advise that to our clients, you know, and so we've got short term and then we've got medium term. And that's what he's talking about. And all the factors are there for a recession, but I'll stop. I'm not a naysayer. It's just, it is what it is. I mean, I look at it like if you know, then you can reap the benefits of knowing, right? That's why you want to know. Whether it's good or bad news, just know, and then you can capitalize on it because you guys can do your own marketing based on that stuff.
How quickly are you anticipating that jump over
5%? I don't know if it'll get to 5, but it'll get close.
It feels like it's going way faster than we thought.
Yeah.
Like I remember at Mega Camp, we were talking, Gary was talking about where he thought we might end up at the end of 2022. And that was like 4.25.
Yeah, we're already there. But
we're already there.
That's right. We knew it was coming.
Yeah.
I was pitching it out to people, God, last third quarter last year. All the writing was on the wall. I mean, the refis were starting to slow down. Inflation was up. They kept talking about it being transitory. My guy was saying it's not transitory, and it's not. It's jumped from, God, we were hovering about 1.5 typically, and then it went all the way up to 6. And because inflation is really a 12-month lag, so as you take off the 12th month and put on the new month, that's why it kept going up. Now eventually it'll come down because you start taking off big numbers and putting in smaller numbers. But anyway, it's going to be here for a while. But inflation is really what's hurting us. And yeah, it is what it is. I mean, there's a lot of stuff that goes into
They
that.
printed a lot of money and gave it to a lot of people, so they got to make it up
Yeah,
somehow.
yeah, and then you throw in COVID when you
Yeah.
have supply chains diminished or production diminished. Now all of a sudden you have limited supply and high demand. What happens? We live that in real estate, right? That's the same problem we have in real estate. A high demand, limited supply. What's happening to our own values? They're skyrocketing, right? So it's the same thing with all the goods out there. All right, so income. All right, so what we're looking for is debt to income. This is now written into a law. Our governing powers, they came in and regulated our industry after the big meltdown back in 2008. So 2010, they came out with the Dodd-Frank bill. Basically, it says the ability to repay. And they spell out all the terms we have to adhere to as a lender. Because a loan is a government loan, whether it's Fannie, Freddie, FHA, VA, we have to adhere to it. That's why when you commit fraud on one of these loans, it's actually a federal offense. But anyway, the ability to repay tells us debt to income ratio. We're looking at what their income is, their gross income, pitted against their mortgage and then their mortgage and their debt. We're going to look at 2 numbers, front and back. Typically, it's only the back that we look at, but front is important too. Some investors have where they want a front to be here and back there. Now, what does that mean? A front end ratio is your gross income paid against the mortgage payment, just your PITI. PITI stands for principal, interest, tax, and insurance. What the total monthly payment is. There could be HOA fees in there too. Principal, interest, tax, and insurance is PITI. So your front end ratio is going to be the PITI to your gross income, right? Your back end ratio, which most people look at, is going to be the mortgage payments, PITI, plus whatever debt you have. Cars, installment loans, jewelry, child support, alimony, anything that you got, that's a monthly debt. We're going to use that bigger number divided by your gross income. And what is that percentage? Your DTI will allow you to get into a loan or not. Jumbo loans really want 43% or below debt to income ratio. We do have investors that will go over that.
Say that again? Jumbo loans, what?
They want 43% or below debt to income ratio.
Okay.
You can go over 43, but your best price lenders are not there. So you can go all the way up to 50. We have investors that will take a jumbo borrower up to 50% DTI. You just pay for it as interest rate because there's more risk. Remember the whole interest rate game, more risk, still have to higher interest rate. But we can still help that client. But that's something we want to talk to the client too. Like, hey, you're on the threshold. I can qualify for that $1.5 million, but that's going to take us over that 43% DTI we expect it's going to have, right? So those are the conversations we want to have with the client up front. But debt to income ratio is huge. And that's why I want to see the W-2s and the pay stubs. Is there any variance? Maybe you just got a raise. You know, is there bonus and commission that we didn't talk about on the phone or overtime? Let me get that verification of employment out. I can't do that without an application and a signed authorization from you. That's why it's important with that pre-approval. So they go onto our site, they fill out an application, and they give us verification authorization to be able to verify all this stuff, right? Because that VOE, again, it's going to come back, remember, it's going to tell you base, overtime, commission, bonus for the last 2-3 years. Now I can actually see what the income is. That's why it's really important. So that because if you're pushing ratios, I want to get all the income I can, right? And then I want to see your credit report because maybe we can pay down some credit cards or do something to fix it. So it all makes sense of why we're getting this stuff up front. I got their income. We're going to send out the VOE for the W-2 employee just so we can look at all that stuff. Now, self-employed borrowers are a little different animal. Unfortunately, they get pummeled when in qualifying because we go off of net income, not gross income for self-employed. So they may have gross receipts of $1 million, but that's not their income because they have cost of goods sold, they have expenses, they have manufacturing costs, all that stuff, right? It's what the net is after all of that. So they may only net 50 grand because in that model, they pay their rent, they pay their home, they pay some of their fun stuff. So their net is lower. So unfortunately, those borrowers get hit hard. And the rationale for that is because, well, if you're telling the federal government it takes all of that to generate that income, well, then we have to go off of it because it's a federal loan. If you just told the IRS that your net income is 50 grand because you got all these expenses, well, we have to adhere to that. That's just the way it is, right?
So it's a good time to tell clients, like before you file your taxes, you might want to talk to your lender.
Mm-hmm.
That's what I'm doing right now.
To know how much to show.
Well, absolutely.
Yep.
Absolutely. Because you might have to bite the bullet. Keep that net up. Because you gotta have a high net for a high qualifying. Because what do you want to do? You want to not pay taxes or pay littler taxes and not own a home or own a home?
Yeah.
So
exactly.
You make the decision. But if it's buy a home, this is what you got to do, right? You want to talk to the lender to make sure. I've had clients. They'll send me the taxes before they file. So I can just make sure, yeah, this with 20 will be fine because it's 21 they're going to file now. So I'm looking at both. But they have to file them quick. Just aside, you don't want to file them and wait until you get into escrow because we have to verify it through the IRS. There's a form that's called a 4506C. Everyone signs it. We send it off to the IRS, we get the transcripts back. It doesn't give us a complete tax return, but it gives us line items. And it's really to catch fraud. We're going to look at this transcript, we're going to look at the actual tax return they gave us, and the numbers should coincide. Line 7, line 13, line 21, all that should match, right? And if there's a variance, wow, right? So that's why it's important for us to, when they're self-employed, to look at their tax returns up front. People will say, oh yeah, I'm fine, I do really well. Well, yeah, you do, but on paper you don't, right? And that's why the non-QM loans that are out there, like the bank statement program loans, are taken off because they're for the self-employed borrower. Because we're not looking at their tax returns, we're looking at the deposits of their business. So that guy who was making $1 million in revenue, he's putting on average $80,000 in his bank account, his business bank account. we're gonna hit him with 50% for expenses. So his qualifying income is 40. And he's gonna qualify for a lot.
So you said that Jumbo wants 43% DTI. What is the regular conventional warrant?
50.
Oh, 50, okay.
Yeah, FHA will allow you to go 47 over 57. 47 being the front, 57 being the back.
And you guys, you don't have to know how to explain all this to the client, right? It's an overview. This isn't your job. But I think it's definitely worth it to know some of the beginning stages of like, well, did you qualify? Because that's often a question like, well, I'm not really sure. So, okay, how much do you make and what's your monthly expenses, and just divide it out.
Yeah.
Right? I make 10 grand and their expenses are 5 grand. They're at 50%, which is what's required minimum, right?
Right. Well, yes and no, because some of the expenses we don't look at. Like we don't look at insurance. We don't look at it.
Right. So there's still a chance, right? But just to know, right?
Yeah. So what we're looking at is just mortgage and any debt that I see on a credit report.
Yeah.
Right. And some debts are on the pay stub, like child support or alimony, won't be on a credit report, but it'll be on a pay stub. And people won't tell you that, right? That's for you to find out, typically. Anyway, I say buyers are liars. It's the truth. Buyers are liars.
But sometimes they don't mean to be, is what I say. In addition to that, like they don't always know, they don't know what they look at, what they don't look at, you know.
But they know they write a $750 child support check.
Oh yeah, that part they know.
So when you mess
That was a fun deal, by the way.
Yeah.
I did one of those.
Yeah, exactly. You know you pay that, but you didn't tell them. But anyway, that's what really is the strength of your loan officer. We're just glorified firefighters. That's all I do, really. Because this X and O's, that's easy. Come on, 43 DTI, FICO score, like anyone can do that. That's easy enough. You got their income, you still with the PITI, boom. Yeah, you're qualified. Anyone can be a lender and say, yeah, I can do that. But you can't, because you need all the background and whys. And that's what you're getting with your lender. It's the glorified firefighter. Because when the problem comes up, and they're going to come up, can your guy cure it? Does he have a solution for it? And that's really what you're getting. Because for me, all I'm doing all day is just putting out fires and dealing with agents like this guy who's about to walk in.
Sunny's on.
Yeah. Hey, is it always sunny in LA?
Someone locked the door.
It's always
Is there food? That's great. No.
There's
Says the guy chewing something on the way in.
Yeah, I found some food.
God. Yeah, I gotta. Are you here to make sure I'm doing it right, or making sure they're here?
Making sure you're doing it right.
Okay. Well, thanks for showing up 15
I was
minutes
gonna
late.
say, I'd like you to know the 2 people who walked in late.
Yeah.
Hey.
All right. So I think we covered it all. I mean, you know, debt load again, PITI. You guys know what this stands for. Look at the credit card payments and pay stub payments again for anything that's in there, right? Could be a 401k loan. So we want to see what those are. Not all of them affect the qualifying, but they could. So that's why it's important to get all that.
Did I miss what VOE stands for?
Verification of employment.
Thank you.
And yes, you did. All right. So next thing is going to be asset. All right. Remember I told you the 3 things we want in assets is down payments, closing costs, and reserves. Right. Sorry. Can I have a? Oh, sure.
Hey, Chris,
Yeah.
one question. Did you already let them know what that one, or how to easily calculate how much buying power people use this and how much the rate goes
You're
up?
still my thunder. That's my last page. She's been through this before.
Yeah.
You know,
I'm a high D, because you
Look at
can't
that.
tell. I'm just giving the bullet points. Not
Okay,
chop,
yeah,
chop.
I'm gonna get to that. All right, so
Disruptive.
Sorry.
really, it's easy on, you know, the bank saves just 2 last months of it. If it's quarterly, like retirement accounts, we'll just get the last quarter, that's it. But what we're looking for is to be able to determine, do they have the down payment, the closing cost, and reserves. I'll write this number down. Closing cost, roughly 2% of whatever the sale price is. Closing costs come up with 2 different parts. There's recurring and non-recurring closing costs. Non-recurring closing costs are hard costs. Those are the costs that just happen at the close of escrow. That's why they don't happen again. They're non-recurring. That's going to be your escrow fees, your lender fees, and your title fees. Right? So that's roughly about 1% of the sale price, typically. Then you're going to have another section called impacts, or what we call recurring closing costs, because they're going to recur. That's going to be mortgage interest, insurance, property taxes, right? So if you want impounds, and most people do, you have to establish an impound cap, and that's going to be about another 1%. That's why it's 2% for closing costs. So just a rough ballpark number. That number changes depending on what month we close. I'm not going to go into why. It just is what it is. So just know 2%. 1% is non-recurring, 1% is recurring. You guys won't get yourself into trouble. So it's whatever the down payment is plus 2%. That tells you if the borrower has enough for that transaction. In addition to that, they may need reserves if they get into the jumbo sector. If they're just buying at 800,000, you probably don't need reserves, so you probably don't need that. But you need the down payment and closing costs. Because if they're going to buy at 800,000 and they're telling you, yeah, I've got 5%, well, 5% is 40, that's all they got. Well, what about the other 2, right? Which is another 16. Do you have that? No.
Did you just plan reserves?
Yeah, we did already.
Okay.
What?
No,
But
but
do you not know?
no, I do know. I just sometimes, you know, the New York agents don't understand.
And just to go back over it since it was a question from the guy who came in 50 minutes late. Reserves are just show money. You've got it in the bank that you say, hey, Mr. Lender, after the close of transaction, I've got 6 months or 9 months of reserve, 12 months. We can use 401ks. That's retirement, and we can use that, right? So it doesn't have to be all liquid, but it depends on the jumbo investors. Some investors, jumbo-wise, say 50% of the reserves required can come from retirement accounts only, or can only come from 401ks, which means that we have to have liquid for the other 50%. That's huge, because most people have reserves in their retirement accounts. So that's really important for us to know, because if I'm going to that investor A, who's got the best price, and I look at it and say, oh yeah, he's got a $500,000 401k, he meets a reserve requirement, but it's like, hey, buddy, yeah, but that investor only allows 50% of whatever you need to come from that 401k. So the other 50% has to come from other sources, like checking and savings, stocks, bonds, that sort of thing, mutual funds. So that's why it's really important to know that stuff so we can relate it to our client. Because again, going back to them after and tell them, oh, we got to go to a different investor and you got a higher rate, it's not a good conversation, right? Unless it's them who misled me or didn't give you the right stuff, that's on you. You know, you can get that yourself, right? Because I'm trying to beat up. But again, I can sleep tonight because I know I didn't do anything wrong, right? Okay. I think that's everything, right?
So cash to close real quick, because this is a question I get, especially in this crazy market, right? So say they show you proof of income, you're gonna write an offer and a proof that you have the proof of funds, and you're like, okay, you're putting only 3.5% down for an FHA loan, right? And now you know that they need another 2% for closing costs, right? So really, there should be 5.5% on their proof of income. I mean, in their proof of funds, right? So now you're gonna go in and write an offer, and then it's in a multiple offer situation, and people keep overbidding, right? So it goes for, let's say 50 grand over what you think this property is gonna appraise for. That they can't be like, oh, we have that 2%. They would have to have another, on top of that, another 50 grand in there to cover that cost to still be able to afford that property, right? Because the bank will only give you, if it's got 96.5% of the loan, right? Because if they only need 3.5% down, the loan will be 96.5% of whatever it appraises for, not for whatever you pay. Okay, so make sure you have all those pieces when you're explaining to the client. People don't know that. People don't know that they are not getting 96.5% of whatever they decide to, right? Especially someone who, let's say they have been pre-approved up to $1 million and the house is only 800, and even if they overbid, it'll go to 850 or whatever. They still think they can go up to $1 million. Right. And you know,
I would have thought that before going through all these trainings.
Yeah.
100% I would have thought that.
Yeah, most people think that.
Yeah.
And so to explain that to them in clear terms, that's a good thing to go over. Like, what do you actually need in your account for this? And by the way, if you're not getting rid of the other property, like the one that Chris and I recently did was they weren't getting rid of the other property, so they had to show reserves enough, like, what was it, 12 months of?
6 months.
6 months of,
Other PITI, not just the property they're buying,
yeah,
but the
For-
property that is now a rental, 6 months PITI. And that's for anyone. If they have like 4 rentals, we need 4 months, I'm sorry, 6 months of reserves for each rental.
right? So now, even if they have extra money somewhere, well, you were approved based on the fact that you were gonna keep that extra money there, right? It doesn't mean they can dig into it. Now, if they dig into that money, they might not qualify for the loan anymore, like my client.
And that's what we're talking about with the
Right.
reserves.
That the reserves, yeah, because they gave them that loan based on the fact that they would have the reserves, right?
Which is the question you asked.
Yeah.
Yeah, you can still get a loan.
Yeah.
You're just not getting that
That-
extra rate. You're going
That
somewhere
same
else.
rate or the same, and then, it's a bummer at that point to try to be like, well, actually, the rate's gonna be this. And by the way, now your payment's way higher than what you thought it was gonna be on this house.
It feels like then you're potentially starting from scratch in the middle of escrow.
Yeah, but the good thing is I can get you a loan, you can still buy the
Oh
loan.
my God, Chris is a genius. He can spin it and he can look for different things and whatnot. So, but you have to kind of whip him a little.
Mhm.
Noted.
Our crying works
Wow.
too.
Just went south.
That's the reason why they put me in the fishbowl. They monitor me all day long. So whipping, yeah, sounds about right.
Or
At least they
bribing.
finally let
Whiskey.
me know, they admit it. Whiskey is good. If you ever want to bribe me, whiskey is good.
What kind? So many options.
Single malt would be the best, but them at Costco's good. I don't care. 4:35 o'clock
I don't
after
see that in the
Saturday.
presentation.
Not putting that in writing.
Discount.
All right. So we've got assets, you guys got it all, 3 sections again, down payment, closing costs and reserves. So when they tell you they got the money, you guys are there, verify it, right? Just real quick, just know 2% for closing costs. So whatever their down payment is, add 2. If they don't have it, you can have that conversation of like, well, I don't know exactly what you're gonna need for your down payment closing costs, but it's roughly here. It looks like we're about 10, 15,000 off. Is there someone else who can gift you the money? We can ask the seller for closing costs, but how good is that going to go in today's market?
Yeah.
Not gonna happen, right? So it's a seller's market. When it's a buyer's market, you can probably get that.
Yeah.
Because sellers need to sell their homes, right? But that's a whole nother topic. So anyway, just those 3 things know about it. All right. So last things, I know this sounds kind of crazy, the do's and don'ts. Once they get into escrow, we really want to let these borrowers know do's and don'ts. Don't open any new credit accounts. And this is actually after they get pre-approved as well, right? Because the last thing you want to do is all of a sudden they went out and bought another car or got a cosign for their daughter's whatever, right? That's going to affect their DTI. And it's a new loan. And it may not even have reported yet on my credit report because they just did it this month and everything reporting was back in January, December, right? And they didn't tell me. Oh, by the way, yeah, we just got a new whatever in February. So now all of a sudden, when we get into escrow, now I have to pull a new credit report. The inquiry is there or the new debt load is there. But in case, just let them know, hey, now that we're doing this, don't open any new accounts, right? Keep it solid. Don't transfer any money on it. A lot of people like to keep transferring. The worst thing that you can do is start transferring from a lot of different accounts because remember I told you I need 2 months bank statements for every account. Well, usually it's just the account you're using your down payment from, checking and savings typically. But they may have 3 or 4 other accounts. Every time they transfer into that account, remember I have to verify any deposits. Well, now I need 2 months bank statements from that account because you just opened the window. Now I got to go to that account. That account has deposits from another account. Okay, that opened that window. Now I got to go to that 2 months bank statements. So there's a lot of things in those bank statements that I don't want to show, which in Sonia's deal, we didn't want to show this pay stub, or I'm sorry, bank statement. I'm not gonna tell you why, stop recording. It shows child support payment. It shows it on the checking account. So I can't use that account, because if I use it, then they're gonna see it.
The underwriter's gonna see.
Yeah, they're gonna see.
So Chris can know, I mean, technically, don't tell him.
Because they see the withdrawals, right? So underwriters look at 2 months and say, hey, what's this $1,250 recurring payment going to? Because they could ask the question. Now all of a sudden you're stuck. There was other things on it too, but anyway, I won't go into all that.
Yeah.
So
what you're saying too, when you're moving your money around, then it's not seasoned anymore. So then
well,
you're
it could
waiting
be,
the
it could
60
be
days.
seasoned because if it's your account to another your account, it's seasoned because it's your money that you're transferring, right?
Okay.
It just makes it really squirrely because there's so
Yeah.
many transfers and we've got to see them all.
Yeah.
And if we don't have an account, that account opened the window, I have to now go into that account.
Okay.
And we might not want that account on the file,
Okay.
right? For whatever reason, we just don't want it. But you introduced it, now I have to,
Yeah.
right? Okay, don't make any large deposits because that's going to be questioned. But if they have to, they sold a car or whatever, yeah, go ahead. But we'll need a bill of sale, right? Because if you're going to sell anything, there's always a bill of sale somewhere. As long as it's legitimate, we see it, transfer title, you're all good. If it's your asset, you're selling, that's fine. It just requires more paperwork. That's just more work for us, more aggravation for them. But that's why I say don't try to do that if you don't have to. Don't pay off any debt unless instructed. Cash is king. Now, it doesn't mean I don't want you to pay off debt. Again, once I look at your credit report, maybe I want you to pay down your balances. But typically, don't do that until someone tells you, because again, cash is king. Because I need, going back to the assets, I need down payment and closing costs, right? And then reserves as well. And if you liquidated some of your bank holdings, I might not meet one of those. So that's why I tell people don't do it unless we have to.
They're still able to do their monthly credit card payment, like
Oh, yeah.
obviously, right?
Yeah, you
I know,
have to.
it's, yeah.
Yeah, if that's how they live, that's fine. They're paying off their credit cards every month. Yeah, okay, that's normal. That's okay.
Yeah.
Because a lot of times people will use a credit card because they get miles or they get perks, right? So I get it. Yeah, so that's okay.
You just don't want them to think like, oh, well, if I pay off this, maybe I'll qualify for some more.
Right, and
Because-
it didn't help the qualifying.
Yeah, it doesn't necessarily help them, and now they have less cash,
Right,
right? So,
Because qualifying wasn't the issue. You
Yeah.
guys qualified for $1.2 million, but you're looking at 800,000. So you guys qualified for it. But the down payment tried to squeak that 5%. Well, okay, but you just dumped 10 grand into a credit card thinking,
Yeah.
oh, that'll help me. No, it actually hurt you because now you don't have that $40,000 for that payment.
One of the mistakes people make is that after they remove all contingencies, that they kind of know that they're gonna get the house, like just waiting to close. They go and buy all the furniture for the house, you know, and that if they check the credit at the end,
Yeah.
then it's gonna show and put effect on.
Yeah.
The other part is make this part of your buyer's presentation. I call it the 10 commandments, and I actually have 10 items that cover that. And it's people actually get a kick out of it, you know, because it doesn't matter how many times you tell them.
Yeah.
Always do something silly.
Sure. No, that's good.
Crazy. Don't change employment status from W-2 to self-employed. You just put yourself in limbo for 2 years. Because for self-employed borrowers, I need a 2-year history, tax returns filed, right? Even if you go into the non-QM bank statement loans, they still want to see a business license for at least 2 years. So even in that regard, yeah, you can go bank statement, but we're going to need a business license that's in effect for 2 years. Because 2 years is pretty much tells a lender, yeah, they're established, they're okay, right? So that's a 2-year requirement. But if they're thinking about it, don't do it. It goes back to that conversation of, well, do you want that new job and no home? Or do you want my house, right? You got to have that conversation with them. Don't miss any payments. Obviously, that sounds stupid, but yeah, you got to let them know. Don't co-sign for anyone because sometimes they think, well, I'm not making the payment. Well, you're obligated to make that payment, right? And it could be that if the other person isn't on that loan, you're like, well, I got it, but my daughter's paying it. It doesn't work that way. If your name's on that loan, you're obligated for it. We're going to get you for it. So those are really just things, do's and don'ts. I try to explain it to clients. The best thing you can tell them is call Chris. I don't know, call Chris, really, because you don't want to give them the wrong information and all of a sudden you're behind the 8 ball. Just call me. I mean, every time we talk to them, it just builds more rapport anyway. I know you feel a lot of calls and it's kind of time consuming, but it's better for me to talk to them and give them the straight. No, you can't. Yes, you can. Or if you're going to do it this way, right? Again, you're buying a firefighter. That's how you're buying. Because anyone can do this stuff. You know, this is not complicated math. It's just gross income, PITI, debt load, DTI. Yeah, you qualify, right? Simple. I mean, it's not that hard. It's the other stuff that goes into it, How do I bring money into a file? What about this? Those are the things that you need, right? So when you get into that conversation with your client, again, who's using the internet or the Missouri loan officer that, again, is a transactional lender, not a relation lender, that transaction is just one. They don't care. But how good are they? And that's why you want to have that conversation that we wrote down earlier, right? Just 5 minutes of your time is going to share you one or two things, right? Either you're getting a great deal with your current lender, or my guy's going to give you a great deal. Either way, you're going to get a great deal. Isn't that worth 5 minutes of your time? It's that simple, right? Okay. My thunder was stolen, but this is what Sony was talking about. I just want to give you guys a nugget. A lot of times you guys are asking the question of like, or they're asking you, well, I don't want to have a payment greater than $3,500 a month, or in this case, $4,500 a month, right? And you're out there, they're going to put 20% down, and they just want to know, will I be able to buy what I want? Well, this is kind of a weird number that I came up with, but I factor in 20% down. It changes if there's mortgage insurance, but I can get you that as well. But the simple equation really does work. It's weird. This will take them to 45% DTI. Right? So what will be affected here, this isn't really telling them to qualify for it, it just tells them what their monthly payment will be, so that you know, hey, if you're looking at an $800,000 home and you want a payment that's $2,500, well, that's not going to happen. Because $2,500, if you go, it works, if you use $2,500 and you divide it by 0.00567, that loan amount should be $440 if they want a $2,500 PITF. Now they're putting 20% down, so if 440 was the loan amount, you just divide that by 0.8, and that tells you sale price of 550, right? 550, 20% down, 110, gives you 441 amount, that'll give you a PITI of $2,500. Well, if you're looking at $1 million home and they want a $2,500 PITI, we need to have that meeting, that come to Jesus meeting of, you're not gonna get that payment, so you need to talk to my guy, because that ain't gonna happen, right? But it goes the other way too. Someone says, I want a $4,500 payment. Okay, then just go 4,500 divided by 0.00567, and that gives you $793,650. That's a loan amount, right? They're putting 20%
So
down.
whatever they have cash down on top of it.
So you just divide that by 0.8, you're now at 992. So you should be at $1 million. Correct. Now you got to verify, do you have $200,000 for the down payment? What else do they need? Down payment, what else? Closing costs. How much is closing costs? 2%. Right. So you just want to verify that on the bank statement, right? 200 grand for close or down payment, 20 grand for closing costs. So you want to see 20, right? Or at least you can kind of have a conversation with them. But the other way around too, they tell you, well, I'm looking at this sale price, and let's say it's $1.2 million, and they're going to put 20% down. So $1.2 million, 20% down gives you a loan amount of $960. If you go 0.67% of that. So take out the 2 zeros and just take what the sale or what the loan amount is and hit it by 0.567%. That'll give you your PITI, 5443. Works the other way as well. So if you're looking at someone who was $1.2 million, putting 20% down, gives them a 960 loan, right? That PITI is about 54.45, thereabouts. You're just giving them a ballpark.
You could just ask Siri too.
I don't think Siri knows this one. I think this one Siri will not know, but it'll just help you so that if they're looking at it and they're like, wow, I really liked it, but they were looking at $1 million homes, now you're selling them up, right? Or they're looking at it. That payment's gonna be up $5,500, and you guys comfortable with that. Right, so just a little tidbit. I always like to leave with, when I can, when I always want to steal my thunder. Yes.
So how do we calculate PMI, mortgage insurance?
PMI is a little bit different because now it's going to factor in what's the LTV and what's the FICO score, right?
So it doesn't calculate with the home price?
No, it has nothing to do with home price. It's going to be FICO score, LTV, and the loan amount too, right? But really it's the first two. So that's why we want to pull a credit report so we know what their FICO score is. And then it's based on what LTV. So it goes, the first thing is 97 to 100 or 97, 3% down, that'll be the highest tier. 95 to 97 will be a little bit lower. Given the same FICO score, it'll be a little lower, yearly premium. You can get it all the way down to, if you're at 85%, you still have to have mortgage insurance because you're less than 20% down. That'll be the smallest. So it's not as great. So that's why
It's like, I tell people it's kind of like car insurance, like it just depends like what you've done before. Yeah, your record, right?
Yeah, so but that's all stuff that we cover with them. Because what I want to do is look at them all, get them qualified, and then let them know, give them a quote, show them exactly everything. Here's your PI, taxes, insurance, HOA, that's what it is, that sort of thing. So they know. Because again, you don't want to put them in the car without qualified. So, any other questions? All right, so there's one other thing I was going to talk to you about since you're already here. So as I told you earlier, this is really what I do on a first-time homebuyer seminar. It's just like this, just more people, more questions. I was going to throw it out to your group. I think we should do one. I think we should do one, plan it out there 2-3 months, and you guys market it. The hardest thing for you guys to do is, get someone into the office and then have this, right? Wouldn't it be better if we all did it together and had one big homebuyer seminar for your group, for your entire group? You bring 1 or 2 people, you bring 1 or 2 people, you bring 3 or 4 people. Pretty soon we've got a big event, right? And I'll show you what we did years back. We used to have a massive spread. It was great. They were really good events. But your people, right? We'll have sign-in sheets and they come in and they get this information. Yeah. They get it directly from a lender. It's something that we can market it.
You can prospect around the event, like for the next 2 months, basically. Right, say we did one in April or March or April, and now you get to do these mailers and whatever, like, hey, do you want to know what it takes to buy a house? And then because the reason it's effective is it's in person, so they're so much more likely to pull the plug on, all right, let's get this pre-approval thing going. Or at least to talk to him like, hey, this is what we think is going to be an issue for us. Start the conversation basically.
Because everyone has their own unique situation.
Yeah.
The big question right now from a lot of the buyers is it the right time to buy?
Mm-hmm.
And for some reason they think the lenders know what they're doing, so they trust it. But just yesterday I was having a conversation with Wade, which is one of my clients here. I sold him the unit. I sold it to him, then I put it on the listing, recently sold it, and he moved to Seattle. And just the conversation that we had, I just got a text saying that he's in escrow. So he made the decision. So I was telling him why it's good to buy right now, but he just happened to walk into my office and I put him on speaker and he told him also why it's important to buy. He went and pulled the trigger and he's in escrow 24 hours later. So when you're having that difficulty with your own buyers, sometimes, hearing it from you is like, you just want to make a commission now, but maybe you want to hear it from somebody else, and that conviction and how you say it is also really important. So I guess, thank you. You have
I work out commission as well, but I come from a different standpoint. I just think someone in my position has to give you the truth. Like, so if you ask me a question, I'm going to give you the truth. Well, it's good or bad. You need the information, right? So if someone's going to ask me the direction, my opinion, I'm going to give them the truth. But I have facts. Why? Because remember I told you about my bond bureaus and all that? I read in one. It's the first thing I do. I look at all of the data that's coming through. So I've got my own opinion. So like I told you earlier, when they ask me that, when you can qualify, when you can afford it, that's when you should buy. There's never, ever been a bad time to buy. Ever. You can go back 40 years. Never, ever been a bad time to buy. Anyone who bought 20 years ago, they're loving life. 40 years ago, they're even more ecstatic. And 40 years ago, interest rates were like 15%.
So they pay way more. And even if
or
they
12 years ago.
Even if they bought at the height of the market and then the market crashed, it doesn't matter as long as you can hold. Right. If all that matters is can you afford this payment?
Exactly.
That's all that matters. If you can hold to the next, because market goes up, market goes down.
Right. And to that, I was in a meeting a couple of weeks ago. I thought it was a great explanation. It was with Farah, and the guy said, because they'll tell you this. Well, my friends are telling me that home values are going down, which is so absurd anyway. But it's like, okay, I'm going to hold off. And Farah just said, look, you do know interest rates are going up. He goes, yeah, I've heard that. She's like, okay. So do you understand when you buy a house, you lock yourself into that monthly payment for the next 30 years, kind of what you're talking about? It doesn't matter what the value of the house is. You can afford that monthly payment. Your family will have that monthly payment for the next 30 years. You're locking into an interest rate and a monthly payment. And I was like, wow, that's so true. Who cares what the value does? Because it's going to go like this. It only matters when you go to sell. Right? And are you buying it as an investment, or are you buying it for a home for your family to establish roots in the community that you love? Right? That's what it comes down to.
So real quick, so you didn't actually, this isn't not what I was talking about. I was talking about that general rule of thumb of if the interest rate rises.
Oh, that's it. No, that's for the next one. Don't steal my thunder.
Wait, you still have another slide?
All right, so the rule of thumb there is 10% for every 1% change in interest rate. Okay, so it keeps you the same PITI. So if you have
a 4%, but you're gonna wait for the interest rate to go up to 5%.
Right, and so let's just say at 4%, you were qualifying PITI, just numbers out there so you say, let's say it was a $300,000 home. That's what you qualify. Based on your income, your debt load, everything else, right? That rate goes up to 5%, you lost 30%. You now have to buy a house at 270.
10%. You lost 10%, 30 grand.
30 grand. Right. You now have to buy a house at 270. Because you maxed out and you're qualifying, that's your PITI is going to be the same. That's what you just lost while waiting. Right?
Does that make sense?
Now, some people are going to say, well, I can still afford it because my DTI wasn't at 45 or 50%, it was at 20, right? I was still low.
Because this is based on the payment.
Right. But it still has an effect on you by waiting because of that 1% increase. It increases your monthly payment by 12%. So you still have a net effect. So instead of a $2,500 payment, you're now 12% higher, which is $250, $300 more per month, just because you waited, right? Because the interest rate game is something people can understand because that's leased out into the media and they see it. It's happening, and it's happened. Just this year,
so every time it goes up,
this year we've seen about a 1% increase. Right. Now this one went to 270. Now you're at 27 less than that, 243. So it keeps coming down. It just is. So it does have a dramatic effect on them. And that's why when she explained it to them, I thought it was perfect. It's like you're buying a payment, a house, but you're also locking yourself into a payment. And that's what's important to know, because as rates go up, and we all know the feds are, it's easy to tell them because they know the feds are going to increase rates. They don't see the disconnect between short term and that sort of thing. And the bond market controls interest rates. People don't understand, but that's okay. The rationale is rates are going up because the feds have done something, right?
But like, think about it, like 300 is, okay, who cares? It's 270 now, like you're kind of in the same ballpark, but when you're up in the kind of numbers that we're up in here, so let's say they qualify for 1.2, next thing you know, they can only qualify for like $1,080,000.
They lost 10%.
For the same payments, you're now can only do $1,080,000. And it makes a huge difference, especially in certain breaking point areas, like for instance, Torrance, a 750 versus an 850 house is like night and day sometimes. You know what I mean? So like if that happens.
And it did happen. The last month and a half. Rates were at like 3.25 beginning of the year. We're at 4.25. It's not jumbo. And we're starting to see separation between jumbo rates and conforming rates. So conforming rates are more Fannie Freddie type, right? Those are higher than jumbo rates. Jumbo rates still are, depending on FICO score down payment, you're still looking at about 3.6, 3.7, but they're inching up too. But why are they better? Because banks want those. Bigger money.
The misperception is that when people think of buying a home, they're thinking of prices going down as them selling the home. But it doesn't work that way.
It cancels out.
Right.
And plus we don't have enough inventory for the prices to go down. And plus prices don't really go down in Paradise anyway.
Yeah,
You're not in like middle of Wisconsin where it's like this, right? Here it's not affected the same way.
Because we live in an impacted area. There's no new homes being built there. I mean, there's teardowns, but you're taking a little ugly one and building this nice big place, and that's going up. And the market's just going to keep going up. But you can't tell people that because their uncle Jim told them that something because he's a welder, but he knows more about real estate than you guys do, right? Well, values are going to go down. They're too odd. They can't keep going up. Really, we've got I think the inventory level is the lowest in 40 years. It's like 2.1 month, which is low. That's why it's such a huge seller market. I think the average day on market is like 12, 14 days. It's crazy. They're getting gobbled up like that. It's because it goes down to demand and supply, right? Simple economics, which is why we're in inflation. Demand versus supply. Our supply channels got hurt, right? You threw a lot of money to the buyers or the demand side of it. So you got a huge demand, limited supply, it's just going to create a higher price. So,
you think less people are actually selling, or it's just that so many people, they're just not on the market for long enough for the inventory to look.
We just don't have enough buildings.
Right.
For the
For the last 10 years, California hardly built.
Right.
Yeah,
it's national.
Well, nationally too.
If you go back, so they start looking at first-time home buyers, which are the millennials now. It's between ages 33 to about 37. When we hit that, that's typically the straight of the market. It just moves. So when you go back there, they should have known to be prepared today to build homes. But like she said, in the last 10 years, developers weren't building homes. Costs of lumber, they just weren't getting permits, whatever, but they didn't do it. And so now we have a limited supply of homes. So it's not just because people don't want to sell, where are they going to go? Right? Sure. So that's creating here in this area. Where are they going to go? We live in paradise, and now they got an extremely low rate. They're sitting on a bunch of equity, but it's like, well, if I sell, where am I going to go? Right? So you got to.
That's one of the biggest objections right now when people to list.
Yeah.
Because it's like, am I going to be able to find something?
Yeah.
So I just had lunch with someone that literally told me that.
Yeah.
Like, where do I go though?
That's
Where do I go?
the biggest question I
Right,
got,
because
too.
it's like I live in $1.5 million house, I get it, and
Yeah.
I only owe $300,000.
Yeah.
My rate's 2.5%, and I'm like $1,000 a month.
Yeah.
We're going to have that payment,
Right.
right? So yeah, they're equity rich,
Yeah.
cash poor. So
It might make sense for people who are moving out of state, which I think a decent amount of people have been doing that over the last couple of years.
that's why when I hear people saying, "Well, I hate this," I'm like, "Need California," I'm like, "Good. I know someone who list your home. It's all good, man. We need your home."
Yeah.
So is there any new changing that like people can buy a single family home and demolish that and convert it to 4 units?
Well, it's all its own.
I heard like the California changed something. So
What they did is they allowed for.
You can split the land, but you
Yeah,
can't.
you can't just arbitrarily take a single family and put 2, 3, 4 units. It's zoning for that city.
Design, yeah.
So you have to go see what the zoning is.
there's no reason to change like 6 months or 1 year.
But what they did change.
SB9
SB9.
allow people to be able to take their lot, depending on size, and be able to divide it, and to be able to set up a second, you being an EDU or second unit. But just so you know, the city of Torrance actually did not want that, so they actually limit the construction to 800 square feet, which it's not worth it to people.
But they could do an
go through the
ADU
process.
without all that.
Right.
Yeah.
You can do an ADU all
Like an
day.
extra building, yeah.
Right, and then I found out recently that Fannie Mae doesn't recognize ADU within 2 or 3 units. So they have a duplex and they do an ADU, it's hard to find financing.
And is there any that's also the reason like the new construction costs is also increased?
Probably.
Like 40-50% they say is
Probably.
increased for this year. So
Cost of lumber,
that's
cost of
also impact.
people to come in, sure. Which is going to our problem that we're talking about, the building. They're faced with the same thing. They don't have, they don't have components to finish some of those homes, like just even computer chips for them, because a lot of the homes that they're building are smart homes too. So they couldn't even finish them. I mean, we were in escrow for how long? Because they couldn't finish it. It was like,
It's an extension of almost 7 months.
yeah, just and they were already started.
And they make the client meet the contract agreement, the agreement on when to sell the home. And, then the client actually I got him a lease back for 2 months or 3 months actually. And then he still had to go and rent a short-term rental because of, careful when you're dealing with builders.
So there's a lot of factors that are going into it, but all of those factors, they're pushing prices up. So Uncle Tom that you talked to at that celebration event, come on.
And everybody
So-
wants to come to California. So everybody wants to live in California.
So real quick, I just want to make sure you guys are clear on the process. So if you have a client and they want to get pre-approved, what you do is you do a 3-way call or email with Chris to introduce them to them. Tell your client this, okay? If you just say the lender's gonna call you, or and you do the intro, they don't pick up the phone. Why? Typically, in my experience, they don't. Even if you do an email 3-way intro, they don't pick up the phone. Why not?
I don't know.
Not familiar with the number.
They think like, oh shit, I don't have anything ready. Like, I'm not ready to talk to the lender, right? In reality, he just needs to talk to them for 2 seconds to know which list of documents to send them, right? Like, are you self-employed or are you a W-2? So that he knows that, okay, let me get you this list just from based on his 5-minute conversation, right? And then now he can send them the list and they can work on the pre-approval process on their own terms, like however long it takes them to get their paperwork to him. Make sense? So you always tell him, look, I'm gonna do a 3-way email with you and our lender, Chris. All he needs from you is to set up a time for 5 minutes real quick so he knows what list of stuff to send you. They will pick up the phone, right? If you don't tell them that, they're like, oh, now the lender's calling me. I can't take this phone call right now, right? It's too much, right? So make sure you tell them that, right?
Because even if I call and I have to leave a message, I'm still going to shoot them out an email because I can reply all. And that's the perfect handoff because they know about me. I can reply all. This is basically what's it's going to be say, it's a pleasure to meet you, blah, blah, blah. If you'd like to start the process, I'll give them a link that they can go into and do their own application and upload the stuff. But I'm going to give you the list of items. It'll be this stuff plus an ID and some other stuff. But it's a list, but it's so easy. And I alter it depending if they're self-employed or not. Or if I talk to them and they tell me that they're retired, they got IHSS income and all that stuff. Those are kids.
What's that?
I'm probably going to pick up my phone after 8. I think that unless we're in a transaction, then I'll pick up. I pick up at 11 o'clock at night if I'm up. If we're handling something. Oh yeah, absolutely. But just on a normal thing, I'm probably not going to pick up after that typically. But there are times I talk after that time. It just depends. Like I'll talk to the client at 5 o'clock or 3 o'clock, and he goes, "Hey, I get off at 7:30. I'll be home at like 7 or 9 o'clock. Is that okay?" Sure. Yeah. Sure. Yeah. I mean, the whole thing is most people. Once you talk to them, you can set up a time to talk. That's easy enough. You just want it to at least start the communication to get them pre-approved because you don't want them pre-qualified. If you get a letter that says they're pre-qualified, they're not pre-approved. You don't know for sure that they're going to be approved. Okay. So in leaving, let's sit down and talk about first-time home buyer seminar if you guys want to do it. Push it out at least 2 or 3 months so you guys can get the right marketing material and you can start pushing it on your social media. But if we can fill this place, it's pretty cost effective. Everybody just chips in and we'll do it like on a Saturday at like
a brunch
10 o'clock.
type of thing.
Yeah, most people eat before they come here. Yeah, we do. Most people eat before they come in the morning. Right, because they're up, they drink their coffee, they have their dish, whatever. So they come, they're not really hungry. So we have like bananas, granolas, yogurt, fruits, orange juice, mimosas.
I would say let us know what our limitation is though ahead of time, because I feel like in my age range, living out here, a lot of us are in this first time home buyer situation and may or may not even think we would qualify for it, but those people would still probably be interested if they're being fed and have alcohol supply. Yeah, they would probably
and
show up
time ahead of time. Reminders and all of that.
So if it's a limitation to 2, then I would have to market that differently, obviously.
No, you bring as many as you want. You bring 50. Bring 50. Okay, that's fine. No, there was a
we had one time we had like 3 girls who did it together with Chris, and they brought in each of them brought in like 13 people.
Okay.
Yeah. So whoever the whole thing is, for me, it's the same conversation. I'd rather have it with 30 people versus 5. Right?
Yeah, you have to speak about it once.
Yeah. It's better for you because they feel like they're at an event and there's 30 people in the audience. It just makes you guys look better too. Yeah. All the way around because it's it's more professional. Versus I've been in some where there's only 3 people. Sure. And I remember the last one.
Like today.
Well, no, there were 3 buyers. I just sat down and shared. I'm like, I'm not gonna even do this. I just sat down and just talked to them. Like, it can be that informal. But for that event, we'll have the whole thing, so.
Totally bring Tony Robbins and fill up the room.
Looks like our COVID, I guess you get.
Any other questions?
So that was very, very helpful.
Oh, I'm gonna be doing an FHAV seminar on what's Friday? It's Friday. 18th, so the 25th, the following. Okay. So make sure you guys are there. That's gonna be open to the entire office. I'm not gonna do Zoom on that. It's gonna be in person.
Yeah.
On lunch, we'll cater it. But I don't want to have to worry about all the Zoom stuff. I'm gonna go back to old school. I do this. I don't do the Zoom stuff. But it's what you need. I think when the market starts to turn, eventually it's gonna get there. We're gonna see a slowdown of offers. You won't see 20, we'll see 10, 5, 2. Then all of a sudden they'll start entertaining the lower down payment programs. You guys need to start knowing what those are. It's not gonna be at the beach. It might be Carson, Gardenia, that sort of areas, but you're gonna need to know them. A little bit different animal. I kind of cover the same stuff, but I just let you know the difference between FHA and convention. All right. All right, guys. Oh, do you guys have cards? You're supposed to sign something.
Oh yeah, the sign-in sheet, you guys, don't forget.
Yeah,
When
we're
going
just
forward.
make sure they do that. Does anyone else have cards? Yeah.
Yeah, that's what
You don't have to.
So going forward without the process, make sure you sign something so you get credit for it. You know, during Zooms and whatnot, we stopped doing it, but KW actually tracks the training. And we measure in those ways, like how good stuff was, and that way we have a track record of.
Yeah, you guys can rate us, and if we're not very good, we don't get to do this anymore.
Well, typically, like the ones that show up, that ones that have those training records on their record, they're the ones selling something, so yeah. There's definitely a correlation that way.
Thanks,
Very good.
Chris.
Got it. Thank you. See you guys.
In just a second, do you have a moment for me to pop in there and ask you that more specific question?
Oh, yeah, great. We can ask you then.
Well, I can't.
She wants privacy.
Yep. Thanks, sir.
I don't want to say.
Yeah.
Earlier, man.
Let this one in this email address.
Have you been over this way?
Yes. Alright.
Is there something we do that?
Oh, yeah.
It's pretty funny.
Like what?
The drop, like it was like the photography stuff, there's the concierge, there's like a bunch of stuff.
Yeah.
Like, oh, we can do this, no payment, this and that, this and that.
Oh, yeah, and then it just comes out at escrow?
Yep.
Yeah.
Did he do a good job?
Hey, how's it going?
Good. How's it going?
Great,
How was class today?
great, great.
I'll be teaching a class today too at 1, I think, or 2.